The rental boom in Australia might be over, with rent increases across most capital cities stalling. New rules begin today for the NDIS, and vintage shopping surges, so much so that major retailers are selling their own second-hand clothes. Welcome to Fear and Greed, daily business news for people who make their own decisions. It is Thursday, the 3rd of October, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, the main story this morning, annual rent increases for houses have hit multi-year lows in Sydney, Melbourne, Brisbane, Perth and Adelaide, suggesting the rental boom is over.
Oh my, hasn't it taken some time to get to this point? Finally, some good news for renters following the steepest and longest rental surge in history, according to Domain's rent report released this morning. For the first time in 9 months, quarterly rental growth for both houses and units has stalled across the combined capitals, marking the weakest September quarter since 2019 for houses and since 2020 for units. Annual gains are now at an almost 3-year low. Over the September quarter, Sydney's rental growth rate for houses was its lowest in 4 years, though the median weekly rent is still $775. Rents were steady for units at $720. In Melbourne, there was no growth in the last quarter, with the median rent for houses at $580 and for units at $550. In the house rental market, Brisbane went backwards while Perth was the strongest performer. All capital cities in the house market are more expensive than Melbourne, except for Hobart. Clearly, rental demand is easing, with a number of prospective tenants per rental listing on Domain falling to its lowest level since 2019.
There's a lot in that, Sean. There's plenty of figures, plenty of numbers. But you boil it all down, finally some good news for renters.
Yes, but there's always a but, isn't there?
There is always a but, particularly when you're involved. You cannot allow me to just be positive.
Yeah, so Domain, well, I'm blame the market, Domain says that despite the slowdown in rental growth, tenants are still paying record high asking rents across all capitals except Brisbane and Canberra, and they're not paying record prices for units in Hobart, but for houses they are. All capital cities remain firmly a landlord's market, with vacancy rates uniformly below 2%. This persistently low vacancy environment makes it unusual for rent growth to stall or decline. Why is that the case? I mean, normally these sort of conditions would fuel further rent increases. In fact, house rents are up 48% since March 2020. Units are up by about 40%. Affordability is clearly a big factor when it comes to this. People cannot afford rents. That's obviously bad news story, but it's actually taking the heat out of the rental market, and it's keeping downward pressure on what people are paying to lease homes.
All right. Now, it seems a good opportunity, Sean, while we're speaking about Domain, to mention our new podcast, which we are producing in partnership with Domain. It's called The Property Pendulum, and it is out today. There's a new episode out every Thursday. It is the podcast that tells you which way the property market is swinging and how to make the most of it. Today, Sean, is all about renovating. It is all about the question of how much do you actually spend on renovations, and whether that changes based on whether you are going to sell the property straight away, whether you're keeping it as an investment long term, or whether you are perhaps renovating to live in the property, and how much you should be paying, how to avoid overcapitalizing. So, look, I think I could talk about that all day.
Yeah, what I did notice about last week's episode, which was more about getting prepared to sell and kind of knowing the market, really, we have no intention of selling our house, but it actually gave me some tips about what I should be doing now, even if I'm not going to sell for 5 years' time or 10 years' time or whatever, just kind of knowing the market. And I thought, that's really, as an investor, even if it's not about my own home, I just I took quite a bit out of last week, you and Alice Stoltz talking about the different, I think there were 4 things you were saying that you really need to do. Yep. And I found that really interesting, even though I'm not selling my home.
Yeah, that's the thing. You never know when your circumstances are going to change. I'm not trying to tell you that things are changing, Sean. But it's good, just good to have this information in your back pocket, right?
Yeah. Oh,
Yeah.
and it's interesting anyway. I just think it's good investment advice. Quite apart from whether you're selling or buying a house, it's just some good investment advice in there.
Yeah, so the new episode is out today, The Property Pendulum. It is called. I'll put a link in today's show notes. It also comes up after this show as well if you just want to just keep on listening, and it rolls straight into The Property Pendulum and you'll hear the new episode coming up after this. Local markets. Sean, let's get back on track. How did things go yesterday?
Well, the S&P ASX 200 closed down a touch to 8,198 points. It dropped sharply on opening, then it rebounded by lunchtime, and then it didn't do much at all. Energy stocks were among the biggest winners, with Woodside rising 3.5%. Santos was up nearly 3%, while the big miners were higher. Plenty of other stocks finished lower, including several tech companies, the retailers, most of the banks. Sigma Healthcare was a top performer, up 8%. That follows the 25% rise on Tuesday after it provided concessions to the ACCC over its bid for Chemist Warehouse. Clearly, a bunch of investors out there think that deal is going to go ahead. Qantas' share price fell another 3% yesterday after the 4% drop on Tuesday. That followed news that Qatar Airways is buying 25% of Virgin. In corporate news, outdoor gear retail group KMD Brands, i.e. Kathmandu, appointed Brent Scrimshaw as its new chief executive to replace Michael Daly. Its share price rose 1%. Gym operator Viva Leisure's share price was flat after posting a positive outlook for the December quarter on the back of expansion plans and a record number of member visits. Love the idea that Viva Leisure is a gym operator. What's leisure and gym's got to do with each other? Do not know, Michael. Anyway, and the battle for Nemo cotton is all but over. Maybe. Privately owned commodities trader Louis Dreyfus has amassed more than 50% of the group after Nemo's directors sold their shares. Louis Dreyfus has been in a battle with Olam Group to buy the cotton ginner. Olam bid 75 cents a share, but was knocked back by the ACCC, which said asset sales might not be enough to allow the deal to go ahead. That's because of the multiple linkages between Olam and Louis Dreyfus, who now seems to have control of Nemo Cotton. Confused? Me too.
I would be confused if I wasn't still about 30 seconds earlier when you pointed out that I know that KMD Brands owns Kathmandu because we've talked about it so many times. I never realised that the KMD in KMD Brands came from Kathmandu, though. And it wasn't until today that you pointed it out that, sometimes we just have never made that association, even though I knew that.
Yes.
Shall we put this in the list of things that I shouldn't admit out loud?
Yeah, I think we should just move on, pretend you didn't say it. I don't think anyone was listening.
Hopefully. International markets, what's going on?
The escalating crisis in the Middle East is hitting financial markets. Finally, safe haven assets such as gold are rising in price while volatility indices are increasing. Oil prices jumped sharply yesterday with Brent trading back above $74 a barrel. The direct involvement of Iran, a member of OPEC, threatens to disrupt oil supplies given the country's output rose to a 6-year high of 3.3 million, with an M, 3.3 million barrels a day in August. I still find those numbers extraordinary that you can pull out 3.3 million barrels of oil from a country. Anyway, the Aussie dollar is also under pressure, having hit a 19-month high on Monday of 69.42 US cents. It's currently trading back below that 69 US cent mark. Crypto assets have come off a bit. Bitcoin's now fetching less than $62,000 a unit. On Wall Street, Apple's strong run since the launch of the iPhone 16 has come to an end, with the stock down 3% yesterday morning. The broad-based S&P 500 closed down 1% just a day after it finished at a record high. That very much reflected those Middle East tensions.
All right, plenty going on. We'll be back in a moment with the rest of the day's business news. Sean, are you looking for a special dividend? Because Rio Tinto, REA, JB Hi-Fi, Mineral Resources and Ramsay Healthcare are good places to start.
Yes, that's according to investment bank Morgan Stanley, which has compiled a list of companies with excess franking credit balances per share. The most efficient way to get franking credits into investors' pockets, or at least onto their balance sheets, is by special dividends that are paid out at the discretion of boards. Of course, they may have franking credits, but not the cash to pay out the dividends, or they may want to use the cash to buy other assets. However, Morgan Stanley have crunched the numbers, come up with these, Rio, REA, JB, Ramsay, Mineral Resources as the companies with a bunch of franked dividends sitting there. Morgan Stanley strategists expect companies to increasingly pay out special dividends, which are, of course, in excess of the half and full year results. So particularly for retirees who are looking for an income stream. Kind of those special dividends are very, very important.
Yeah, and on that topic, Sean, of retirees and super funds, you've got an interview coming up after the show with Mary Delahunty, the CEO of the Association of Superannuation Funds of Australia.
So it's all about legislation being not passing yet, being pushed by the federal government through the House of Reps on the taxation of superannuation balances over $3 million. It's called Division 296, Div 296. ASFA represents the super funds, so you would think that they wouldn't like the idea of taxing higher superannuation balances more. That's not the case. They've been involved in the consultation. They understand the need for it. But their point is that the money raised from that should actually be used to help people with low superannuation balances. So it's a really interesting chat about that issue.
Yeah, it sure is. It's coming up a bit later on in the playlist. Now, Sean, a new list of approved and banned items kicks in today for the NDIS, and sex work, tarot card reading, yoga classes and cuddle therapy are out.
They are. The 1-year transition period for people living with a disability starts today as part of the federal government's efforts to reduce the fast rising cost of the scheme. Approved items include assistance animals, mobility supports, transport costs, help for some household tasks, behavioural supports, prosthesis, nursing care and modifications to the home and specialist vehicles. Items no longer include accommodation costs, groceries, cigarettes, vapes, illegal drugs, technology products not related to disability care, clothing and beauty products, pet costs, wellness services, firearms, airline lounge memberships, as well as ones you mentioned, Michael. This is a really big issue which is going to play out politically for a number of months and probably years, certainly in the run-up to the next election. Some of the items you talk about, sex work, and that it's a lot more complex, I think, than the headlines suggest. And I certainly don't live with a disability, so I don't it's unfair for me to say that I fully understand the needs of people that live with a disability. But certainly there'll be some people very upset about what's on the list and what's not.
Indeed. Now, Sean, one of the longer-running bank fights is over after ANZ failed to overturn a ruling that said it breached disclosure laws during a $2.5 billion capital raising in 2015.
ANZ broke disclosure laws which require companies to inform shareholders of events that may affect their share price. When it didn't tell investors it had failed to raise the whole $2.5 billion in a capital raising almost 10 years ago from institutional investors. The raising was $790 million short. Now, it was underwritten by 3 investment banks, so the money came through. But days later, there was a retail investor raising. And last year, Justice Mark Mashinsky ruled retail investors should have been told about that shortfall. ANZ appealed the finding and the $900,000 fine, but the full bench of the federal court dismissed the challenge. It isn't so much the money. It's not really about the $900,000. It's just that it's in the media again. It's the look of the failed challenge that's a problem for ANZ. And the chief financial officer at the time was Shane Elliott, who is now the CEO. He's under pressure anyway on some other issues. So it's more the look than the money, I suppose.
How about this one, Sean? Samsung is laying off staff in Australia as head office looks to cut costs.
About 10% of the workforce could go in Southeast Asia, Australia and New Zealand, according to a report on Bloomberg. It's not clear how many people will lose their jobs in the local market here, but Samsung has about 147,000 staff outside South Korea. 10% of those are going. Samsung's share price has fallen 20% this year as the world's largest maker of memory chips and smartphones, struggles in key markets. It's fallen behind its main Korean rival in the memory chips used for AI and has made little progress against Taiwan semiconductor manufacturing in the production of custom-made chips for outside customers.
And the boss of Country Road Group has conceded the retailer has suffered its worst financial performance in its history.
Ouch. Now, that will trigger a rethink of its structure, potentially new leadership teams, and probably cost-cutting, which likely will lead to job losses. Country Road Group will restructure its sourcing and supply chain while also looking for better pricing deals with suppliers, according to a report in The Australian. In an address to Country Road Group staff at its Melbourne headquarters yesterday, Chief Executive Raju Vapalapati said recent staff surveys were confronting and show a sharp fall in staff morale. Mr. Vapalapati said Country Road Group, whose brands includes Country Road, Trenery, Mimco, Witchery and Politics, has experienced a perfect storm of economic challenges. He also acknowledged that internal workplace issues were playing a part.
Turning to international news now, Sean, and Republican vice presidential candidate J.D. Vance outpointed his opponent, Democrat Tim Walz, in the only debate between the two ahead of the US presidential election in less than 5 weeks' time. It is getting close.
It sure is. Consensus was that the 40-year-old had beaten the 60-year-old, who really didn't help himself by continually taking notes and wandering through answers. It was a much more civilised debate than those between the presidential candidates, although much of the debate was focused on Donald Trump and Kamala Harris. It covered immigration, abortion, foreign policies. It just covered a bunch of serious issues. And of note, Mr. Vance refused to concede that Donald Trump had lost the 2020 election.
Israeli Prime Minister Benjamin Netanyahu has vowed to retaliate against Iran after the Islamic Republic fired ballistic missiles at Israel as the region slides ever closer, really, towards all-out war.
Speaking after the Israeli military said Tehran had fired about 180 missiles at the country, Mr. Netanyahu warned Iran had made a big mistake and said it will pay for it. And I quote, "Whoever attacks us, we will attack them." Israel military spokesperson Daniel Hagari said most of the Iranian missiles had been intercepted, but added there were a few hits in the centre and other areas in the south of the country, according to a report on the Financial Times. He said the military was not aware of any casualties. A person briefed on the situation said the Iranian barrage had targeted military and intelligence infrastructure near Tel Aviv and other facilities elsewhere in the country. In a social media post, Iran's foreign ministry said the action is concluded unless Israel decides to invite further retaliation. Meanwhile, Prime Minister Anthony Albanese condemned Iran's missile attacks and called for an immediate ceasefire and for diplomacy to resolve the conflict. The Prime Minister also said pro-Palestinian rallies planned to mark the October 7 anniversary of the terrorist group Hamas's attack on southern Israel should not go ahead.
Finally, Sean, I mentioned this one at the top of the show. This is a bit change of pace to finish up today.
It is.
Vintage shopping in the US is booming with sales at 7 times the pace of the broader retail industry. 7 times. That is huge. And some of the big retailers are jumping on board.
Yeah, so vintage shopping, I just think that's kind of the trendy way of saying buying secondhand clothing. Would you agree?
Yeah, it's had a glow up.
Yeah, so some of my kids talk about going vintage shopping and I'm like, what, St. Vinny's?
It's going into Vinny's before you had like a pub run or something at uni in Bathurst when you had
something like that.
Yeah.
Something like that.
Yeah, it was like an 80s night at the uni bar and everyone would just go into Vinny's.
Vinny's. I mean, to be honest, these sort of thrift shops are a little bit more upmarket than Vinny's. In fact, in the US, retail giants including Banana Republic, Madewell and H&M are getting into the resale game. This is all from a report in the New York Times. Others like Lululemon, J.Crew, Abercrombie and Fitch use third parties to resell their clothing. In fact, there are now about 25,000 resale stores in the US. The other thing that's really interesting, many of them have an online presence, but this is much more about going in, checking out the clothes, looking at them, saying yep or nope, and buying them off the rack, which is like a return to a very old-fashioned pre-COVID trend, actually bricks and mortar retailing.
Yeah, vintage retailing as well. Got a bit of an issue here.
Yes.
Sean.
Go
with
on.
the idea of, say, Lululemon reselling clothes.
Yeah.
Because that is activewear, right?
Yeah. Yeah, it's good. But I'm not into secondhand clothing, full stop. Like, who's been wearing it before me? What sort of sweaty person has been wearing it before me?
So you wouldn't, would you buy like a jacket or something secondhand?
No.
Really?
Like, I'd like to say I would, but no, wouldn't go near it.
Okay.
Smelly, sweaty. Who knows the word?
Oh. Sean Upper Class Aylmer refusing to go secondhand.
I think snooty's a better word.
This has got weekend edition written all over it. And I look forward to
does.
getting stuck into this topic and getting stuck into you during that podcast on Saturday. Up next, 2 things to listen to in the Fear and Greed playlist. First is the new episode of the Property Pendulum, brought to you by Domain and Fear and Greed. And after that, the Fear and Greed daily interview with Mary Delahunty, the CEO of the Association of Superannuation Funds of Australia.
Yeah, we talked to Mary all about changes to the taxation of super at the top end with balances over $3 million. But what the government should do with that money, if the legislation passes, and how they should use it to help people who don't have so much super.
They are coming up in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It is Thursday, the 3rd of October, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X, TikTok and Facebook. I'm Michael Thompson and that was Fear and Greed. Have a great day.